Hi everyone, welcome to episode 10 of my Learn on the Go series. And it seems all one can talk about nowadays is Lenskart. Even I buy my spectacles from there, and with regards to their IPO, these are the numbers that are floating around. The company is valuing itself at almost 70,000 crores, net profit of almost 300 crores, but this is unadjusted. So if one removes the one-off gains, then it's more like 128 crores, but let's go with this. And of course, 69,000 divided by 297 gives us a P multiple of 234. Lenskart calls itself a tech-enabled company. पता नहीं चश्मे में क्या tech enable होता है, कुछ तो होगा. But alternatively, let me present you another company, justdial, which is also tech-enabled, and from a numbers perspective, it has a market cap of 6,600 something crores. So that's a discount of 90% to what Lenskart is valued at. The FY25 PAT was double of what Lenskart managed, which means currently the P ratio is at less than 12. These guys had just released their Q2 numbers, and see this, the market cap, it's even less than 6,600. So it's 6,587 crores and the P ratio is now 11.6. In terms of the stock price, it got completely rogered in the last 1 year from 1100 something, and it's now down to 774. And in terms of the P ratio, what was 150 price earning multiple way back in 2022, it kind of normalized to around 50-60 in 2023-24, but now it finds itself going way down to the 20s, and it's almost getting into single digits at the moment. Okay, let's continue. And while the price and the P ratio has been going down, something that's been going up every quarter is actually the sales of the company. So look at this. 205, 221, 233, 47, 61, 65, all the way till 303. So not a single quarter, at least in the last 13 quarters, have been negative quarters for the company. In terms of net profits, not as much the case. There have been slight ups and downs, but generally it has been an increasing trend. Let's move on to the balance sheet and see this. The company barely requires any fixed assets, just 128 crores in fixed assets. It also has, let me expand this. See, there are no borrowings, either long-term or short-term, and that's been the case for quite some time. But the part I find most impressive is this. So in terms of cash equivalent, it has 152 crores as of September 2025. And can you see this entry here? 5,418. This is investments. And now let's look at what those investments are. Let me move on to the annual report. Okay, let's go down to the balance sheet. All right. See this, investments 4968. This is as of March 31st, 2025. Note number 5. Let's quickly look at note number 5. Is there? Yeah, there we go. So investments, first up, we have a lot of bonds which are there. These are tax-free bonds. So this is about 302 crores. Then we have a bunch of mutual funds. All of these are debt mutual funds. So we have another 433 crores plus 4,231 crores. So 4231 plus 433 plus 302 gives us a little over 5,400 crores. So let's get back to this. So in terms of assets, what we are looking at is a cash of 152 crores plus another 5,400 crores. So all of it is cash technically. And what this means is that justdial has about 5,570 crores worth of cash in a business, which is remarkable for a company whose market cap is only 6,587. So essentially, we have a company, a tech-enabled company with a market cap of 6,500 plus crores. It has no debt to speak of. It has cash within the company, which is some 5,600 crores, which is 85% of the market cap. And it has the ability to generate about 500 crores in PAT every year. Now, it's a mystery on why the prices are so down, why the PE has absolutely crashed from 150 to almost single digits, and that is what we're going to find out in this video. Before we get to that, let's look at the disclaimers. Ghadi Sankat ki khabre. And what this disclaimer really says is, firstly, I am a SEBI-registered research analyst. I don't own any shares in Just Dial Limited. I haven't received any compensations from the company for making this video. Please do your own research. Investing in the stock market is risky, and everything I say or show in this video is for educational purposes only, and none of it should be taken in or construed as a recommendation. Right, so let's understand this business in detail. And Just Dial is what one might call as a local search engine. That's the company's core offering, and if you need a dentist, a wedding planner, a contractor, a painter, courier wala, it's all there on the company's platform. It's a massive database they have, one that has grown from 3.1 crore listings in September of 2021 to 5.1 crore now. Just Dial ensures these listings are updated, relevant, and verified. They also come with geocodes, most of them, and also with images and video. So that's the supply side. And in terms of traffic, this too has been growing. This last quarter, that is Q2 of FY26, almost 20 crore unique visitors were clocked across platforms. That is through voice, on its website, and on mobile apps, which is where most of the traffic is, a good 87%. But what surprised me was 2.7% under voice services. This means there are still 17-18 lakh people who dial 88, 888, 88, 888. So 10 times 8 on their phone for teleassistance. Alright, let's examine how the company makes money, and there are essentially two ways of going about it. Firstly, there's the search business. This is the bread and butter. And the way this operates is customers, which in Just Dial's case are the sellers of products and services. These customers pay a subscription for placement in search results. You can think of this like those sponsored ads which come on Google on the top of the search results. So something similar. And as a proportion of revenue, this is like 98% of the operating revenue the company generates. Another interesting point is where it says services provided over a period of time. And what this means is, from an accounting perspective, Just Dial recognizes revenue only when it is earned and not when it is received. I'm sure accounting folks will understand this bit. It's called accrued earnings, but let me explain this for the benefit of all. Okay, so Just Dial offers subscriptions to its customers. And like any subscription plan, it's a prepaid model, that is, the customer pays the money upfront. So essentially, this customer has paid for 12 months, but if I'm still sitting on January and have an entire year to go, then Just Dial's accounting policy does a prorated assessment of revenue, which let's assume in this case is 1,000 rupees. Similarly, had I been in July, that is the 7th month, then my earned revenue will be 7,000 rupees, while the balance 5,000 is yet to be earned. This unearned revenue, or deferred revenue as the company calls it, is an important variable in assessing Just Dial's future revenue and something everyone should pay attention to. I also love the fact that because Just Dial gets all its subscription money upfront, it has zero receivables and also works on negative working capital. Other than search, the company has also built quite a few transaction platforms. I won't go too much into it because the contribution to revenue is quite negligible at the moment. But just to reference what the company is up to, they have offerings like JD Mart, which is a B2B marketplace, a bit like Alibaba, but kafi chote scale pe. JD Omni, that offers cloud-based solutions for SMEs. JD Pay, that's into payment solutions. Then there's ratings, analytics, business, and a few more offerings. Most of these services are designed and expected to complement Just Dial's core search-based business. But from what I've read and understood, many of these transactional platforms are yet to scale up. So that's a quick overview of what Just Dial has been up to. And let's now try and understand why the company is so cheap. We've already looked at the P ratio. It's at 11.6 presently. But I think what would be more apt to understand here is the EV to EBITDA, the enterprise value upon the earnings before interest, taxes, depreciation, and amortization. The reason I say so is more to do with the profit and loss statement. And look at this. This is one of those few companies where the income from the other income is actually more than the operating profits. So this is 387 crores of other income in FY25 versus 335 crores of operating profit. As I explained earlier, a large part of this 387 crores comes from the cash and the debt mutual funds within the company. So if one were to quickly calculate the EV upon EBITDA, let's do the EV first. So EV is nothing but the market cap of the company. So that's 6587. Let me pull out a calculator. Yeah, 6587. We now add the debt, which is 0. So we don't need to add anything. And we have to subtract the cash from here. So in this case, it's cash and the investments. So let's go down to the balance sheet. It's 152 plus 5418. So minus 152 minus 5418. This gives us 1017 crores. So that's the enterprise value for Just Dial. And we have to now divide it by the... Actually, let's take the trailing 4 quarters of operating profits. So 87, 86, 86, and 87. Okay, how much is this? So this comes to 346 crores. So 1017 divided by 346 crores gives us an EV upon EBITDA of 2.93. अब ये चिराग लेके भी घूमोगे ना तो इस टाइप का नंबर आपको मिलेगा नहीं. It's quite a rarity to get a EV upon EBITDA of 2.97 for a company, which calls itself a tech company. So yeah, interesting. And I think what will be even more interesting is for us to understand why is the stock price of Just Dial going down and down in spite of having such delicious valuations and also a massive cash reserve of over 5,500 crores. So that's anyway the quest for the day. And let's start with a few reasons around it. Of course, I'm just theorizing, but the first reason has to be around growth. I say so because in the last 4-5 quarters, sales have risen by only 6-7% on an year-on-year basis. But if one looks at it sequentially, then see this, 281 crores, then 285, 287, 89, 98, 303. So there's not really much happening here. In fact, in April of this year, the management did acknowledge the waning revenue growth numbers. And they even try to justify their 9.5% yearly growth as still decent in the current environment. Of course, the aspiration here is to accelerate this growth number from the current 9.5% to the mid-teens, that is around 15%. And where are we now? Okay, so from those heady days of 39-40% returns, the growth has come down to 27, 20%, 16. And for the last 6 quarters, it's been spiraling down, and 6% is definitely nowhere close to the company's 15% aspirations. Even on deferred revenue, notice how poorly this has grown in the last 1 year, 515 crores to 526 crores. So that's just 2%, which surely doesn't inspire much confidence in me at least. The point is, as a company, you can show me all kinds of metrics. Web traffic is rising, app downloads are up, the ratings are so excellent, listings are on the rise. Jo dalna dalo. But the fact is, if your revenue isn't growing, or if it's growing at 6%, which is the case here, which is actually even less than the growth in GDP of the country, then I'm sorry to say it is not going to be enough to excite the investors, and this will sooner or later reflect in the stock price of the company. Now, a second reason that might be leading to investor apathy is the high competition that the company faces and the possibility of disruption to its core search business. This competition is not just from domestic players, but increasingly from Google search. So, for instance, if you want, or if I want a list of event planners, then all I need to do is to go to Google search, just type in event planners near me, and it would give me a nice list of businesses. Okay, there are quite a few of them, and this comes along with their ratings, with the phone number, the timings, and photos, and all kinds of other stuff. And the third reason that's contributing to Just Dial's poor show in the stock market, and which I think is the biggest reason of them all, is the lack of clarity in the company's capital allocation policy. I'm essentially talking about those 5,500 odd crores of cash and investments that's there in the company's balance sheet. And it's an important one, so let me give you a quick background of this. Now, Just Dial Limited has always been a cash rich company. In fact, the sum of their cash plus their investment holdings has been over 1,000 crores since 2017 onwards. And notice what happens in FY22. So what was 1,573 crores in cash as of March of 2021 rose to over 3,800 crores by the end of next year. How did this happen? Well, it all began in July of 2021 when Reliance Retail Ventures Limited started buying a controlling interest in Just Dial Limited. This was done via a series of transactions, one of which was a preferential issue that in turn infused an additional 2,165 crores of cash into the company. So one way of putting it is that it's the Reliance Group that is responsible for the massive cash reserves of the company. And in terms of shareholding, Reliance Retail Ventures Limited currently holds a 63.84% share. That said, let's get back to the cash inside the company, those 5,500 crores. And obviously, every equity analyst who is tracking this particular company or every investor really wants to know what the company plans to do with this number. The problem is that, whenever this simple question is asked to the management of the company, the replies that are given makes this scenario even more complex and murkier. For instance, in July of 2023, the management indicated that the cash could get utilized organically or for acquisitions, although they had no targets in sight. Then next year, in July of 2024, they mentioned having an internal discussion on a dividend policy, which could be 100% of the annual profits or even higher. Please note, 100% of annual profits comes to a dividend of around 500 crores. So 500 divided by 6,500, which is the current market cap of the company, gives us a dividend yield of 7.7%, which I think is an awesome number. But yeah, this was said in July of 2024. And if one looks at what was said in April of 2025, and I'm just reading out this line, at this point of time, this particular agenda on returning cash via, say, dividend has not been taken up. We expect the same to be taken up sooner, most likely by next quarter. Well, that quarter has already lapsed, and with the management doing less and less earnings calls nowadays, it's becoming even more difficult for anyone to understand what exactly is happening or to gauge what the next steps will be. That said, I should mention cash is probably the most optionable thing that's out there. And if someone's going to say that we don't know what to do or we have not decided on the next course of action, then it's definitely something that no investor in the world is going to accept. So let's see what can be done, and the best way of going about it is to have a good, bad, and ugly scenario around it. The good option is to give it back to the shareholders. Dividends are best. It comes directly to the shareholders, and it's a very clean transaction. A strong justification for dividends comes from what the company has been doing for many years now. So they have a bunch of cash with them, and they've been adding more cash over the years. And all this money is going into debt mutual funds, which is probably earning them 6.5%, 7%. On this 7%, tax is also paid. So that's another 25% that gets knocked off. And what comes back is a post-tax return of maybe 4.5% to 5%. Let me explain it on the screener, and let's go to the balance sheet. So see this, assets in this case can be divided into two parts for us. So part one are those fixed assets. So that's about 128 crores. And then we have the second major asset, which is the cash in the company, which is some 5,500 odd crores. So against the 128 crores of fixed assets, the company is earning an operating profit of 335 crores. This is as of FY25. And against the 5,500 odd crores of cash, what the company earns for its shareholders is 387 crores. So on approach number one, which is purely on the fixed assets part, the ROA is something like 270%. So 335 divided by 126. And on the other part, which is the ROA on the cash investments that we're doing, it's more like 387 divided by 5,500, which comes to exactly 7%. So this is a problem. And I think instead of the company retaining all that cash and delivering some 4.5%, 5% to the shareholder, if that money was to come to people like you and me, I think we would do a much better job of it. So the learning here is just because the company has a lot of cash does not mean it is doing a great job of it. How efficiently it deploys this cash to generate even more returns, I think that's the true criteria on which any management should be assessed upon. Okay, let's move on to bad deployment. And there's always the possibility that the company might use up a chunk of this money on some acquisition or a bunch of acquisitions in the hope that it'll kickstart or rather restart the company's growth engine, which does not normally work. I think IndiaMart is a good example of that. In the last 2, 3, 4 years, they have sunk in more than 1,000 crores in different acquisitions. And while there has been some traction on this front, it isn't really something to write about. Now, as far as the ugly use of cash goes, and this is just conjecture on my part, but now that Just Dial is probably trading at a discount to its fair value, imagine a scenario where Just Dial decides to do a buyback. Let's say many of the frustrated retail investors decide to participate in it. The shareholding of Reliance Retail Ventures, RRVL, goes up from the current 63% to let's say 90%, and they decide to delist the company. As I said, this is just a hypothesis, but it definitely aligns with why the Reliance Group might have invested in Just Dial Limited. So by deploying some part of the cash to increase their shareholding, RRVL can now get complete control over the company. They can change the brand, make it GeoDial or something, and Just Dial as a company might cease to exist. Of course, to go for the good, bad, or ugly option is a decision that's entirely controlled by the board of directors. So let's see who's on that board. Okay, so there's VVS Money. He's the founder of the company. I think he has about 9 to 10% of the shareholding. There's Mr. Sudarshan, Mr. Pandit. We have Mrs. Bama Krishnamurthy, Professor Jain. And look at this. We have Mr. V. Subramanian, who is currently serving as the managing director of Reliance Retail Ventures Limited, RRVL. There's also Ashwin Khasgiwala, who has been associated with the Reliance Group for more than 18 years. Geeta Fulvadia, who's also been associated with the Reliance Group for over 20 years. Anshuman Thakur, he's been there for more than 10 years and is currently Senior Vice President at Geo Platforms Limited. And finally, there's Mr. Tanuja, who is currently serving as the Chief Financial Officer of Reliance Retail Limited. Right, so 5 out of the 10 directors are associated with the Reliance Group. At this point, I will leave it to you to connect the dots. But as I always say, investing is a game of probabilities, and it is up to you now to process the information that I've already presented in this particular video. You should research for more information, try and collect as much as possible, and then arrive at your conclusion. As it stands, Just Dial hasn't paid a single paisa of dividends for over a decade now, and in spite of sitting on over 5,500 crores in cash, we still have no idea on what the management plans to do with all that money that technically belongs to the company's shareholders. I'm pulling out a quote that Madhav so eloquently said in his Substack. Just Dial is a textbook case of a cash-rich, return-poor business. It's too efficient to die and too indifferent to scale. So what are my biggest lessons here? Number 1, having a large cash pile, while it offers security per Benjamin Graham's way of thinking, it also imposes a direct penalty on shareholder returns if that capital is not actively deployed or distributed. And we saw that in terms of the ROC and also the stock price. Secondly, valuations are often cheap for a reason, and while Just Dial seems to be deliciously priced at a PE of 11.6 and an EV to EBITDA of less than 3, the stagnation in growth and the lack of clarity on capital allocation has turned what was a fast-growing technology-oriented business into something like a sleepy PSU with a Nath. Number three, I should definitely point out to the Reliance factor. And given that it has a 63% stake, there is always that possibility of a delisting in the future. I should also mention the Reliance Group is not exactly a champion for protecting the interests of minority shareholders. You can refer to what had happened with Den Networks and with Hathway Cable, and more recently with Reliance Retail Limited, where it had cancelled all non promoter shares, and those people were stuck up with they actually received probably half of what was the ongoing price in the gray markets then. And the final lesson is that of monitoring specific triggers, especially those that are in the management's control. In this case, it's the company's capital allocation policy. But if one looks deeper, then it's also the growth in business, it's the lack of inorganic opportunities, there's poor execution of new initiatives, and the handling of partly external variables like competition, etc. At the end of the day, investing is all about conviction, and true conviction can only come in when you read, analyze, and discuss these situations. So, this was episode number 10 of my series. When I first started Learn on the Go, I had made this promise that I would make at least 10 episodes, and I'll gauge whether it's useful or not, or how people are reacting to it. So, from the comments, I think a lot of you have found it to be very useful. And in fact, even I have found it to be very useful. And all this research has definitely been helping me. As far as Just Dial goes, again, I'm not giving any kind of recommendation, but I would say that it's better for any existing investor or any person who wants to get into it to wait for a catalyst to happen. There is a lot of uncertainty on what's going to happen, and it's better to wait and watch actually in this particular case. You can use this information, you can use this template that we have to examine other listed companies. So companies like India Mart Limited, Den Networks, etc. So a lot of these follow a similar template. And if you kind of go through that exercise yourself, I would love to read about your observations. Please do share it in the comment section below, and I'll see you very soon. Bye bye.